But you might think I'm a big bad wolf, so I won't. Oh!
It's been noted that recently the yield curve has inverted. Say what? The yield curve. Well, it's a difference between long and short-term rates, as a graph, let's say. And here's one. It's across about the last 10-odd years. And sure enough, they're right. The short-term rates are relatively now larger than the long-term here 10-year rates. And when does the last time that happened? Ooh, that was pretty scary times as well. Here's a longer-term perspective of short-term versus intermediate versus longer-term rates. And generally, short-term rates are less than long-term rates, and we're going to see a reason for that. Here's a longer-term chart of bonds, this type differentiated by the types, with generally the highest rates shown here being kind of risky bonds, and generally the lowest here, generally green, are municipal bonds, which, because they're generally tax exempt, usually have also a lower yield. Going back to the spread between shorter and long-term rates, here's a shorter-term perspective. There's a reason for that, and that is longer-term bonds should give a better yield, a higher yield, because they are riskier to the investor. Likewise, to the borrower, they are willing to pay those higher rates because they get an asymmetric preference in that if rates fall, they get to refinance them with a call provision, but if rates rise, they still like them because they've locked them in. Here's a graph I've created of the interest rate risk, sometimes professionally called the duration, of various bonds, maturities, coupon rates. And generally speaking, the longer term the bond, the greater the interest rate risk, which means to an investor, you don't want that, so you're willing to go short term and tolerate a lower return. Added to that liquidity preference, per Sir John Hicks, is expectations. Expectations being that of expected long-term interest rates, function of longer-term inflation per the Fisher equation, and we can do some calculations. I've done this in another video where we can use either arithmetic approximations or more precisely geometric ones. But what I'd like to do is now contrast this to, say, P/E ratios. Here's a graph from Schiller with long-term returns graphed against P/E ratios with various decades, the warmer colors being more recent, showing an inverse relationship, meaning lower P/E ratios are associated with higher returns and vice versa. And these two do get coupled together in that, well, first of all, historically, there is an inverse relationship between P/E ratios, interest rates, and inflation. We can see this is across a long-term graph where the extreme opposites are observed, but every once in a while you'll also notice that is not always the case. And that's where I like to come in and point out that some of the gurus who just look at one number or another, but not understanding the relationship between them, that there is a theoretical relationship. Look, valuation model. Price of a stock times 0 is the next dividend divided by the discount rate minus the growth rate. Where do those dividends come from? Earnings times a payout ratio using conventional notation. That's 1 minus the retention rate, again divided by the discount rate minus the growth rate. Now, if you divide the earnings, you get a P/E ratio, which is, again, the payout ratio divided by the discount rate. But now let's disaggregate the growth rate, which comes from the retention rate that the firm has chosen times the achieved rate of return that the company does make. And that's differentiated by the company's location, style advantages, its patents, its good or bad management, etc. And we're going to call that BR. Now, in equilibrium or on the margin, you would think, especially in the long run, that the K and the R's should converge. And when you do that substitution, look at that. The PE ratio is the reciprocal of the going discount rate, and indeed confirms the historic inverse relationship with a little bit of perturbations between interest rates, read inflation, and the PE ratio. Now, what does that mean in terms of long and short-term interest rates, the inverted yield curve, which turned negative for the first time since 2007? Well, you'll notice it's not quite signaling that extreme. Moreover, we know that tomorrow's news is what really affects changes, because if we expect it already, it's been incorporated now. What do we make of this? Well, first of all, there's always conflicting sources of information, and indeed we do have lower rates, unexpectedly so, in the mortgage market. Home sales have pulled back a bit. Well, the expectations says we're expecting lower inflation, which may mean a downturn in the economy, often the case. We have mortgages have pulled back. But then why is the stock market up so high? My point here is it's an artifice of the valuation models. PE ratios should actually be high when there's low interest rates, and the low interest rates are indicative of a downturn in the economy, which seems counterintuitive until you look at the math with Dr. C Invests.